Well, good afternoon, investors. And again, we're not started yet. We are getting started now. Welcome to the May 9th edition of Bull Sessions. My name is Mark Robertson. I am joined here by Ken Kavula, who has just scrambled in from his trip to the Georgia area and returned to repair an internet, apparently. So we will knock on wood and hope he's okay. We will knock on wood again and throw salt over our shoulder and hope that my audio stuff behaves. It seems to be behaving okay now. You guys can all hear me okay, right?
You're coming through loud and clear, Mark. Yep.
Okay, good. So welcome back, Ken. And then we are also joined by a couple familiar names, Kevin Gologly from the Maryland, D.C. area, and Matt Spielman, our current groundhog leader from Houston. Good afternoon, guys.
Good afternoon.
Good afternoon. Hope it doesn't jinx me.
Yeah. Mark, Len is reporting that your voice is coming through to the audience softer than everybody else's. I don't know if we dare ask you to turn your volume up a little bit, but we could try. I'm getting the same report from a couple of other folks in the audience now that you're very soft.
Well, I will move it up a little bit and see if
Well, maybe not that much.
maybe not that much.
Yeah, bring it down just
Just back it off a little bit.
all right, up a little bit more from there. Maybe a little bit more.
Wow, I just barely touched it.
That's good. There, you got it, Mark. You got it, okay?
Oh, that button is way too sensitive. No wonder.
All right.
Toss it around. All right, well, hopefully my voice will behave okay for most people. We are going to spend just a few minutes talking about the weekend in Omaha. I know a bunch of people that go there routinely. Kim wasn't able to do it this year, but she's been an attendee a number of times. And we'll just check in on a couple of things. Just a quick reminder that we are looking to hear what your favorite podcasts or webcasts are with respect to investing. So we'll stop in on that. And then I actually made a little bit of a sojourn down to southern Indiana and back. And during the trip, I kept getting pummeled with this notion of maybe it's even a new tagline: making successful investing unimaginably imaginable. And I think we'll spend just a few minutes just exploring that a tiny bit and see if it's got any legs whatsoever. But that's where we're headed, so let's go ahead and get underway. This is just our reminder that this broadcast is not sponsored by Portillo's, but it should be.
I should tell you, Mark, that the CEO of Portillo's had a lengthy interview on CNBC 3 days ago now, and it was quite interesting, some of the things he had to relay, including the fact that their foray into Florida has been extremely successful, and the stores in Florida are actually outselling the stores in the Chicago area right now.
Whoa, that's good news.
Yep.
They're probably, if they're in Florida, they're probably on the Gulf Coast side because that's where most of us Midwesterners go.
Yep, absolutely. Good stuff. All right, no investment recommendation whatsoever is intended. This is about education, illustration, and demonstration. We're basically trying to extract and share lessons learned over 8 decades by the modern investment club movement with respect to discovering opportunity and analyzing said opportunity and building a portfolio where we hold the investments that we make for as long as it makes sense to do so. And we attempt to demonstrate that here. So we'll be talking about our interpretations of that. You must do your own homework before taking any action. We do a monthly webcast called The Roundtable. If you'd like to be added to a email reminder list for that, just send an email to nkavula1@comcast.net. Anything else you need, our email addresses are there at the bottom of the page.
And just a general reminder that the roundtable this month will not be on the last Tuesday as it normally is. It'll be on the 4th Tuesday. That'll be May 23rd. We've moved away to make room for Memorial Day and to allow ourselves some time to get ready for the virtual BINC convention that's coming up at the end of the last week in May, first week in June. So the 23rd of May will be the next roundtable. And that reminder should be going out fairly soon to all of you on our guest list.
Yeah, I've seen at least one reminder, and that is 2 weeks from today. Okay. Just checking in very quickly on the condition of the market. Again, the green bars represent the average stock position per the standard edition of value line. So you can see it's below the blue line, and we basically feel that that says that there's some opportunities. You know, not basketfuls of opportunity, but there are some opportunities out there to be discovered. And our two quotes for today. The first one we've covered a number of times. I just put it up again just as a reminder about building an image, imagining, and being able to see stuff. And of course, there's that 5-word potential tagline, which is going to fit in, and we're going to talk about that here in a few minutes. Any thoughts, Ken, or did you have any unimaginably imaginable moments on your road trip?
Well, I've been reading this tagline that you sent to me earlier today or late yesterday. I don't know when it was, but I'm trying to make it into a tagline that I can, play around with here. So we'll have to see what you have in mind. It's 5 certainly very interesting words. We'll have to see where they're going.
Okay. All right, so let's keep rolling through some of our preamble stuff here. Matt's been posting a number of things, as has Len Douglas and a few others sharing their thoughts on the bank crisis. I did temporarily become a shareholder of Western Alliance again last week, Ken, but I left the party again. So with a fairly decent gain from just trying to take advantage of some of that irrational mob behavior and hopefully irrational mob behavior longer term, but certainly shorter term, some of the opportunities that have been created by what I think is almost a fostered mob mentality with some of these banks.
Today's been another dramatic move in some of these banks again. At the beginning of trading today, some of these banks were off 3, 4, 5%, and now they're moving up towards the even mark again, towards down decimals, down fractionally. So again, they're being kind of buffeted around by forces that I don't think they have a whole lot of control over. That whole idea about reasonable is just being trumped by the mob at the moment.
Yeah, and the lady from Grit Capital actually made the point that I believe PacWest is up to a 20% short position now. I know Len tracks that stuff, but I know that there's definitely some overactive activity going on with some of these companies. And again, the chart on the left is from the guy who was made famous back in the financial crisis. Michael Burry was one of the guys featured in the film about the terrible financial problems that happened back in 2008, 2009. He's one of the
Big
guys,
Short.
The Big Short, yeah. He's the one who he's credited as being one of a group of people that basically saw that collapse coming and benefited from it greatly, but it almost wrecked him in the amount of time it took for it to happen. And it's interesting coverage in the movie. So he put out this chart on the left, and it's kind of interesting because this goes back a couple of weeks now, where he's basically just charting the banks that have the higher deposit thresholds. So higher on the chart, the more vulnerable you were to a migration of deposits, and that's what happened to those that are X'd out on the upper right. And you can see that Western Alliance is down in that range with Citigroup and JP Morgan, not too far away from them. So again, only time will tell, but perhaps they will avoid some of the real nastiness. And then PacWest is actually down even a little bit further. But a lot of these companies are in the news, and it's interesting. I really don't know what to think of it in total, other than, and we'll talk about it probably in a minute, Warren Buffett basically made the statement that, yeah, there have been some very questionable management decisions, but he basically said, in his opinion, that the messaging and the failure to deliver any understanding to the American people is probably a bigger cause of the situation. And Matt, I didn't get a chance to listen to your post from Chris Whalen. Can you summarize that? It was posted on the Manifest Forum today.
Yeah, I mean, Chris is basically, and he had some very sober thoughts when everything first happened, which is when I started paying attention to him. But he is looking for more trouble, not only in commercial real estate, which a number of people have commented on, but in credit quality in general. If and when either the U.S. goes into a recession or something, let's say recession-like happens, if the debt ceiling debate doesn't get resolved before it has some kind of specific effects. I mean, the rumors of it could happen if it actually, if the U.S. does stop payment on some things, that'll be unknown territory, and it's just a matter of all banks other than the big four are somewhat more fragile, if only because of the investor sentiment and depositor sentiment at this point. And so they just don't need more trouble.
Mm-hmm.
But in terms of what that means to him, and what really caught my eye in this video is he was a Western Alliance shareholder, and he didn't say when, but he said he did sell out of it, not because he thinks there's a deterioration in the company, let's say specific to it, but rather because of the macro situation and that he finds the sector uninvestable. So I disagree with that point. I'm still invested in Western Alliance, but as we've talked over the last month, it's good to listen to all the opinions too. And I think he just states his opinion in an even voice, and with even though a lot of it is opinion and is yet to be determined, his thesis, his facts are fairly straightforward.
Mark or Matt, could one of you clarify the letters CET1 in front of capital on the x-axis there, what that stands for?
Yeah, that's a Basel III standard measure. That's I think it's capital equity tier 1. So that's a certain level with certain deposits, which are liabilities to banks, versus your capital, how much capital you have. And
Yes.
so, and there's a CET2, and I think there's a CET3 to
Is it better to be to the left of the vertical line or to the right of the vertical line on this particular measurement?
On this chart, no, that's a really good question, Ken. So generally, you want your CET1 capital ratio to be higher. If you have a higher level of capital compared to your overall assets, you're safer. You can cover those assets if they leave. In this chart, the whole line is unrealized losses as a percent of your capital. Mm-hmm. So the idea that there's a loss you may have to book if you have to sell some assets, which will degrade your capital level. So in this level, you want it to be to the left. If we weren't measuring unrealized losses, but simply had a graph of the CET1 capital level, you'd want it to the right. Generally speaking, if a bank is over 7%, well, let's say this the other way around. If a bank goes under 7%, they attract regulatory attention, say it that way. Most of the regional banks in their Q1 earnings calls were citing 10% CET1 as their target for stability. And might be straight. Western Alliance is expecting to be it's at 9.6 or something now. It's expecting to be 10 by the end of the quarter. They're looking to strive for 11% to give even some more on there. But they were as low as 7 when it all started. So they've worked hard to sort of shore that up versus the regulatory level. But in this chart, what left is better.
So if I'm reading this chart correctly, then the best place to have your dot is in the lower left-hand quadrant?
Generally, yes.
Correct, and that makes sense from a sort of a 4-quadrant thing, right? All the X's are coming in the upper right, so you want to be in the opposite corner.
The opposite corner, right.
But I will also say, I think this, because the Western Alliance, they may have it by now. They had not issued, even though they issued earnings, they had not issued their Q1 yet. They were going to be May 10th is the actual deadline date.
Right.
As of 2022, they actually have sold off they've realized all the losses and sold that off already. So the 9.6% CT1 is post unrealized losses. So if we updated this, let's say next week, if Michael updated this next week, Western Alliance should go all the way to the left.
Yeah, and the other thing to keep in mind, and I can't speak to the exact conditions or the covenants or anything else, but there has been relief given to these banks on these unrealized losses too. So that is not covered in here, and I'm not sure when Burry put this chart together, but this is kind of as it all kicked in. And many of these have changed fairly dramatically with that relief that's been given. And so the conditions have changed, along with the stuff that Buffett and everybody have been pointing out, that no depositors are actually in any jeopardy at all. And I'm that's way too bold to say, but they're basically saying they're going to cover deposits.
Yeah, what stated or not stated, if it came down to it, and the top government officials are sweating it over the weekend, they're not gonna let someone some depositor take the hit when they haven't in the last 2 or 3 times.
Mark, I'm going to clarify one more point before you move on to this slide. Can you go back to where you were?
Sure.
Can you just give us a 7-second bio on Michael Burry himself?
So Burry basically runs a hedge fund, and he's been a consultant to a number of companies. Again, you can Google him and catch him on Investopedia. As Kevin pointed out, he was one of the stars of the Big Short movie back from the 2008-2009 financial crisis. And he's basically portrayed as a fairly colorful character in the movie. Quite the eccentric, creative, innovator type individual, and it's an interesting study to take a look. Now he's popular on Twitter for the stuff that he posts, and the people on Reddit have a lot of fun with him and that type of thing. So that was more than 7 seconds, but that's his role in all of this. Noticing.
Okay, and one more suggestion to our audience: if you can't see bank names or symbols next to some of the dots, I would suggest you change the angle of your laptop if you possibly can, because when you change the angle, those very faint letters that are there show up much more clearly than they do if your laptop's a little bit flatter. So move the screen a little bit more to an upright position, and you'll see those letters appear very clearly.
Maybe he was just trying to hide the ones that he actually owned. Who knows?
Could be.
Oh, Ken and Mark, if I can add one other thing about Burry, just so people know, is that he's a medical doctor by training. Mm-hmm. And he did this on his own. And he was, when he was doing all the short selling during the Big Short, people were sort of criticizing him. And he said that he was really a value investor, and he really sort of harkened back to, to Benjamin Graham in terms of his approach to things. So, and he just saw this misallocation, and that's when he started shorting it in the housing bubble.
It's a wild story. I highly recommend the movie if you've not seen it. It came up on our movie list 6 or 8 months ago.
Christian Bale.
Yep, Christian Bale was the actor. Here's the damage that's been done to them collectively. They're down 30%. I was listening to a group of gurus talk about going in because of this amount of damage, price damage that's been done. That's, again, most of it's probably not warranted. Now, there are going to continue to be problems with some. And the point made by Chris Whalen was that the rapid increase in interest rates is not something we've seen, and any attempt to quantify the amount of balance sheet damage done, there's just very little experience with it. So that literally is what you're dealing with.
Yeah, and I'll say, I mean, it's not just these 5 or 6.
Right.
Essentially, almost, and probably not the biggest ones, I haven't really checked them, but it's basically any bank you could name is priced below tangible book at this point. I have a discussion in an early retirement forum, a whole different forum, with a guy who's a fellow Texan, but he's an ex-bank risk management executive. And so he is not as attached to return on average assets, as Ross has taught us to be. But he simply looks at banks he knows because he was in the business. I mean, even let's get down from regionals to community banks, right? Single town banks with maybe 5 or 10 million in revenue, not billions or hundreds of millions. And he finds them very intriguing. They're average banks in terms of performance. They might be an ROA of 1, but they have, century plus deposit bases who if they weren't, if they haven't moved for, online banking apps, day trading, whatever, they're not going to move. So he finds those as the most stable asset bases and therefore the most attractive because they also are even at a discount to their liquidation value.
And they're probably.
I hesitate to add to what Matt is saying. I own 3 banks: Western Alliance, First Financial Bancorp, and Isabella Bank and Trust.
Oh no!
Isabella Bank and Trust is a small, exactly what Matt was referring to, a single bank. And Mark, it's not an oh no situation.
Well, if it's publicly traded, are we going to have a bunch of community banks showing up now?
I hope not, because finding information on the bank and even trading the bank is not the easiest thing in the world, because there's not a whole lot of float to some of these community banks. But I own Isabella Bank and Trust for a couple of different reasons. Number one, I wanted some exposure to the state itself, and that gave me state exposure, but it's acted in a completely different way than Western Alliance, or for that matter, than First Financial has acted in the last 3 or 4 months. So I'm interested that Matt has given me perhaps a reason why it's acting differently.
Yeah, absolutely. I'm looking at it now. Mid-Michigan Bank. Good stuff. All right, let's keep rolling. Here again, here's making the point. I have a feeling that Isabella Bank is probably not stuck at 0.1% interest on their savings accounts, and this lady is actually just making the point that we made a few times over the last couple of months, that some of those major banks out there, including JPM, Chase, still has very low interest rates on their consumer accounts.
I think not to pile in on the what ifs. I don't remember if Chris said this. Sometime around the time I was listening to that last video, also came up an interesting point. If the debt ceiling issue is imminent, meaning June 1st, as Janet Yellen has said it could be, it's interesting to the extent that people have moved into money market funds rather than money market accounts at banks, which are FDIC covered. Money market funds could face some kind of flash reaction that could threaten some of them to break the buck again, like that happened in 2008 without FDIC insurance, which was a short-term thing added in 2008. So it's kind of interesting, wondering what the setup is for people fleeing either to yield or to security. Where are they going to go next?
Wild. And of course, Musk chimed in. All right. In that same Grit Capital, they actually had a commentary on Omaha. So let's switch to Omaha. They said, where else can you watch two guys eat peanut brittle and talk about investing for about 6 hours?
And celebrate the 100th birthday of one of them.
Yeah, it's coming around. And they actually said that was, he had a coronation a long time ago. It's been King Charles at Berkshire for a long time. But actually still this one from you, Matt. This is how they opened the afternoon session with, they changed their name tags. And we were searching for any in-depth commentary on the commercial real estate stuff, and Matt and I have been discussing. I don't think it happened.
No, there was an interesting. So these signs were revealed again. They were blank halfway through, so they're just waiting for something to come up. There was a very interesting point, a question that brought this up, and it was kind of critical of them. Of course, Berkshire Hathaway reported 35 billion in earnings, and how many 100% more? I think it was 7 billion last year, with a great deal of that difference being just the value of their equities having gone up. And so the question was, as much as Warren has been critical of having to mark to market, seeing that was actually in some sense hiding issues in the banking system, would he change his mind? And of course, they had a very good answer. Obviously, they had anticipated some answer there. Their answer was, and really it was their practice before they had to do it, was they believe in marking to market on the balance sheet, but not to have that go through reported earnings. I forget what they named it. They had a special category of income, whatever, special income or other income, that they would throw the portfolio in anyway, instead of putting that down into net income before and then mark to market in the balance sheet. So that's the difference there. They saw no need to change their opinion in terms of what happened.
Yeah, and in fact, they pointed out that the vast majority of their cash equivalent type stuff is invested in very short-term T-bills, and they've actually made out extremely well with the monetary situation over the last several months. So, good, clean fun. Yeah, he was not kind about the criticism of some of the messaging going on in this environment. All right. One of the things that he did present, either indirectly or not directly, in the past, he has put up something very similar to this. They might have done it during the movie. I didn't see the movie, but here's a look at the book value. This is total book value. It's not intangible, Matt. Total book value over a very long time frame. I find it kind of interesting because there's definitely two different growth phases there, but very consistent for a company that is largely a property and casualty insurance company. Good piece of their business, of course, less over time, but they basically track the success of Berkshire Hathaway and rate the investment performance using this chart, or a chart very similar to this. It kicks off the annual report to shareholders every year. Any thoughts, guys?
It's a remarkable track record. I mean, they've obviously slowed down, but given the expectation that as you grow, it's harder to grow so much more, it's amazing that they've kept it up at this point. They talk about looking for a $70 billion company they could take out because they have $130 billion in cash.
Yeah,
there just aren't that many opportunities.
He slipped up and wished that he only had $50 million to invest or something at one point.
Yeah.
And he said, "Whoops, I take that back."
Next slide.
It's actually pretty good to not have that. Here's a look at Berkshire Hathaway, the way under the microscope that we put these type of companies. And again, the book value per share, very steady. You would expect some zigging and zagging with a company that's built with all the components that they have. And again, it's pretty well up straight and parallel. Everything pretty well behaving on this particular visual analysis. All right. I am kind of frustrated that that is their corporate logo on the upper right. I was looking for something flashy. There's nothing flashy about them. It's just cool.
You're surprised by this?
It's extra spending. They talked about the bank in Rockford that they owned long ago, and in all these banking questions, and they said they brought in a new CEO, and the first thing he wanted to do was build the most impressive building in town, and they told him he couldn't do that.
Yep.
They wanted the ugliest building in town.
Was that Rockford, Illinois?
Yeah.
Okay. Cool stuff. All right. We'll keep cranking along. I just thought I'd throw this one out there. Some people have asked about the type of selling decisions that are made during our roundtables. And we do put this on the forum and summarize it basically when we do it. And you can see this is a set of 15 different positions, some of them going all the way back to 2015. And again, we keep track of how well do the actual individual transactions do versus the Wilshire 5000. So when you see over on the far right, first of all, the actual return is this one annualized that you see here. But we always compare that versus what did the market do during that time frame to get the relative return. So most of them worked out pretty well. The average is 6.7%, as is shown on the slide. And again, just a cause for celebration and some really nice gains made by virtually many of the knights and damsels that were involved with the roundtable over that time frame. Any thoughts on any of these, Ken? You build on Universal Health. That one did very well against a very challenging environment over that 3-year period.
Well, no, I'm not going to make any comments. Let's just let's just keep moving.
We'll leave it at that.
Yeah.
All right. So here's our current groundhog standings. Matt has taken over the lead. He's actually widened his lead during the day here today. And during the day today, number 45 has actually moved up to number 40. We were just looking at the start of the meeting. So, Ken, you've actually joined the top 40.
Yay!
Kevin is
going to talk about you now.
Yeah.
All right.
Top 40.
Kevin did ask for a recount, but he's withdrawn the request.
Oh, all right.
I have nothing to talk about. I'm clearly right in the smack dab in the middle.
I'm feeling really good that I'm in the top 40 without Ardelyx in my portfolio. So, you know.
Well, Ardelyx has helped me out a lot, but it's kind of holding me back right now a little bit. It's certainly been quite bumpy. And
I've been mining where I can find Ardelyx in the different portfolios, and the folks that took advantage of it certainly are up near the top of the contest right now.
Yeah, without a doubt. And we do own shares in our family of Ardelyx, so keep that in mind. It's been kind to us so far. It's been kind to the Roundtable tracking portfolio. The other thing I thought I would point out here is, for the first time in quite some time, Kathy Wood's actually making quite a charge. She's actually up to 106th here. And that's kind of refreshing. And the monkey's actually moved up a tiny bit, Ken. But he's still south of Kevin. All right.
So what, I'm the new Mendoza line? Is that what you're telling me?
Hey, I think we all take turns with the Mendoza line, so it's not anything to worry about too much. All right. So yeah, there's some strife going on right now in a number of our selections for the best small companies. Ken mandates that we not spend too much time on this, but Semler does report here. Hopefully we'll get some decent news out of them. We have sagged back down to trailing by a good 6 percentage points. The one thing that I am watching with interest, because I've never watched this quite as closely before, is these negatives that are creeping in down here. And then I want to take a more comprehensive and a multi-year look at this just to get a feel, because I think it might be one of the better recession indicators that we never use. And just kind of want to wrap some thoughts around that. But we'll see. Well, the companies are all coming in fairly decent in general, but things are getting kind of wrecked a bit. All right. Anything else on that, Ken, that you want to?
No, I'm kind of watching the top of the red bar up in the graph, Mark. I'd love for it to at least stay at 1 million, which would indicate that we haven't gained or lost very much at all as the year goes by. But we have quite a bit of time yet until next February 2nd. So let's get off this picture and move to one that's a little bit more enlightening.
All right. We got some very positive feedback on actually going through the calculation of projected return on enterprise value last week for industrial companies. So I did want to take a moment. This actually is much shorter and it's much more direct. I think you will find it very interesting. We do actually do it differently for asset-based enterprises, just like you would expect. We tend to lean on book value and return on equity for all asset-based enterprises. And interesting point. Greenblatt basically gave up on them, and he does not use them, at least in the magic formula stuff that I reviewed. He kind of sets them aside, and because of some of the irregularities and some of the challenges, he also does very little with smaller companies. So neither of those two were acceptable to either Ken, especially Ken, or me. So we basically went looking for some way to handle these asset-based businesses. And in this case, you can see that we have put together a slightly modified version. You still have to figure out the projected operating income for the company that you're studying or analyzing, but you really only need the stock price and the book value. So let's go ahead and take a quick look. Any thoughts on that, Ken?
Well, I'm getting some reaction about where'd the cash go to, but I think I even have the answer to that. I think the cash went into the book value. It's still there. It's just kind of hidden now, where it was a item unto itself on the industrial company. So it's still there, folks. Don't panic.
It's still there, and so are the liabilities. It's just a matter of rolling it all in and simplifying. In the case of when you start studying banks, and this is something we've touched on a little bit, it can get quite confusing, especially for beginning investors. It's confusing to all of us, some of the cash and the liabilities and all that kind of stuff. And trust me, when it comes to some of the analysts covering these companies, they get confused. So you get a whole bunch of chaos and noise in the data. So much like when we switched from long-term debt to liabilities for the industrial companies, basically setting the cash aside, and it's covered in the book value anyhow, just embedding it in there, it covers a whole lot of, as I said, chaos and noise from a statistical standpoint. So it actually got kind of cool. All right, so here's a quick look at J.P. Morgan. J.P. Morgan is in the headlines for being one of the major acquirers of one of those troubled banks, First Republic, and many people think that J.P. Morgan's in pretty good shape and probably in better shape once the analysts embed the impact of First Republic. Time will tell. We'll see. So the first thing you want to do is figure out the 5-year book value forecast. And in this case, the current book value for J.P. Morgan is 94.34. And again, you just need to escalate that by the growth rate. The growth rate coming straight from a place like Value Line, you could choose 4.5. If you actually look at this trend here, it ends up being 5.5 or 6%. So again, something in that 4 to 6% is the result of your study. That's what you would use. We used 6% here to come up with a future book value of 126.14. Now keep in mind,
Mark, you do mean book value per share in these calculations at the bottom of the page here, right?
Yes, these are all book value per share, just like it's shown here. Okay? And again, they're not going to match up completely because the 4.5 is different than the 6, and the 529.08 is different than the 2027. So keep in mind that on the Value Line page, that point in time that is shown right here is a different point in time than the number shown down here. So for now, we'll just use that 126.14 going forward. The only other thing that you need at this point, we need two things. We need the rate of return on equity and the effective tax rate. So again, pulling from a source like Value Line, you could use Morningstar. You basically need some type of an understanding of what type of return on equity seems appropriate. 15-ish makes a lot of sense. The income tax rate, according to Value Line, is expected to be or projected to be 23. So you basically have all that you need, basically calculating the future earnings by the projected book value, that 126.14 times the return on equity. And then that same old calculation that many of us performed many times with manual stock selection guides, we're basically taking the taxes out and putting it back to pre-tax conditions by using that number in the denominator. So that takes us back to 24.57 per share. That is our projected 5-year operating margin forecast. Any questions or thoughts, Ken?
The questions are clear at the moment, Mark.
Okay. So here it is. You basically have that 1 point. And again, the important thing is it's projected. You won't find that anywhere in data online. Projected operating income of 2457 divided by, in this case, because everything is per share, this is just simply, it is the market cap, but it's expressed as the stock price. And here's the current day book value. So you end up with a projected return on value, enterprise value, of 10.7. So it's a quick and I think fairly effective characterization of the situation for any asset-based company. And again, we refer to it as a modified Greenblatt, and it gives us a fairly decent situation. How decent? Here's two ways of looking at the same thing, much like we did last week. You can calculate using PE ratios and a more traditional calculation on the right, coming up with a projected annual return of 11. Again, that's based on a book value growing at 5.5 or 6. Projected return on equity of 15.8. That's analyst consensus estimate. And injecting the dividends in there, but coming up with a projected annual return of 11.1. That compares pretty favorably versus 11.2. I didn't cherry pick this one for the two to line up that closely. You'll find that they line up fairly closely a fair amount of the time. Okay.
And in fact, when they don't, that's been one of the best uses of proof. The practical uses of proof is when they don't line up. It's telling us something. It's telling us something profound in a lot of cases.
Yeah, and even if you're a relative beginner at stock studies, when you start chasing the differences, chasing the variances, and trying to understand what causes the differences, you can learn a lot pretty quickly. And as Ken just said, a lot of times it will come down to that PE ratio being perhaps unusual or maybe requiring a little bit more thought. So here's a look at the company just in the form that we put out online, so you can see this is a fairly steady company, excellent quality over time, projected returns that are actually quite steady. So it's an interesting blue chip stalwart holding, and they may be benefiting pretty well from what's going on with the current crisis. And here's a look at the lower page. Again, one of the other things I wanted to make a point of, we do have return on assets on a bunch of asset-based companies, but make sure that you understand that in this case, the return on assets at this particular bank, I think it's on the previous page, is not flashy by the way we think of regional banks, but it actually is pretty good because the return here for an average return on assets for banks in the diversified group is different than what we kick around for the regional banks. So again, it's a matter of perspective and context. Okay. Any other thoughts on this, Ken?
Well, just to put a cherry on top of that sundae you just built, Mark, essentially these banks that we're looking at here, JP Morgan, Citigroup, banks like that, have a very, very different business model than the typical regional bank does. And they're operating in a lot more businesses. They're doing a lot more things that have varied profit margins attached to them. And you wouldn't expect the ROAA to compare favorably between that one group and the other group. I think if we're going to be fair, we probably could come up with what we think is a pretty decent return on average assets for a money center bank. There's only a handful of them in the country. What are we talking, 6 maybe 7, Mark?
They fall into this category, probably,
yeah.
Along that line, 6, 7, or 8.
Yeah. And if necessary, you could do proof on all of them and see where those proofs tend to cluster. But to compare them to the return on average equity from a bank that has a much more simple business model isn't fair and isn't going to give you much information, I don't think.
Okay. So take a look at the slides, go through and get more comfortable. With that, I want to just turn briefly to this notion of unimaginably imaginable. And we're going to do it in the context of the lessons from legends. And Ken, here's what I basically picked out just to kind of frame the discussion today. 5 of these points, some of them we've talked about before, but this notion of discipline and imagine, and I know you like all these, understanding history and what really matters when it comes to understanding your investments. And I mean, I just love this list, and I think there's much we can do with it.
Somehow, Mark, in the last month or 6 weeks, I've put another word into my vocabulary, and I've been trying to grapple with my own psychology as to when does discipline become stubbornness. And I think that's an interesting topic. I don't see it addressed on this particular list. I see, there's some avoids in a couple places, and there's be adaptable, and there's dealing with loss and those kind of things. But I think it comes down to knowing enough about yourself also to know that if you're a disciplined investor, you do have the tendency is the wrong word, but you do have the possibility of allowing your discipline to move into an area which is just plain old mulishness, stubbornness, and discipline is good. Stubbornness can probably get you into some trouble.
Ken, do you think it could be the one, the third one down from the bottom on the right, balancing confidence with humility? Do you think that could fit in there?
Yeah, that I'm looking to see real quick where you're looking, Kevin. Oh, third one from the bottom there on the okay. Yeah, absolutely. And I think dealing with loss and being adaptable all fit the whole concept too. So it's not necessarily one, Mark, but maybe we can grab those in a couple of circles and treat them as a single one and deal with that issue occasionally. I think that's when is it time to throw in the towel? We've had a lot of problems with that with the roundtable portfolio over the last 5 or 6 or 7 years. We thought we had brought it down to some numbers, and yet we're not very happy every time the numbers tell us to get rid of something. We're finding reasons why we shouldn't. And I don't know if that's stubborn or if that's discipline. I don't know which it is. And I think it bears more discussion because we got a lot of pushback from our friend Cy Lynch when we first began talking about this idea of exiting positions based on some numerical data.
Yeah, it's a tough issue. There's no doubt about it. I think we could probably very carefully study. I mean, we have a couple of times when we stopped out and prevented a massive loss.
Absolutely.
And when I say massive loss, again, in the context of that Microsoft thing that we talked about a couple of weeks ago, and we'll be talking about it again, massive isn't really fair. The case study that comes to mind is Fossil, where I can actually point out and I can actually quote, well, both you, Ken, and others, that basically said this thing is in trouble from the Apple phone when the Apple Watch first came out. And we kind of ignored that, and we were stubborn, and we paid a price for that with the roundtable tracking portfolio. But I think I don't know if you ever get away from this. It really comes down to you put your discipline in place, and you do have to let your selections have some room to run as long as the fundamental story is intact. But in the case of Fossil, I think we can make a case, and you made the case, Ken. Halfway down that decline, you said we're in trouble here. And we were stubborn.
Well,
maybe it's a matter of too much faith, too. Too much faith in Fossil.
The two examples that I would like to put into a discussion, and not today by any means, but to put into a discussion, I'd like to put the whole home building industry into a discussion and look at what happened to that industry over a 6 or 7 month time period within the last year. And then I'd like to put the regional banks into that position as well. I have been laying asleep in my bed and waking up at 3:30 or 4 o'clock in the morning and asking myself the question, am I being disciplined in holding what I'm holding, or am I being just stubborn, not wanting to admit that there's something wrong that I can't have any impact on, and therefore should be looking for companies where the kind of problem that the banks are having right now, or that the home builders had, that kind of problem doesn't exist. So maybe those kind of companies don't exist also. Flip that coin over. But
It's
it's a topic that I think bears some discussion. I really do.
okay. Well, we certainly will go there, and the regional bank story is still unfolding, but I think you can again, I'm just thinking off the top of my head, you can roll back to the Hugh McManus argument. I want to buy a bank, not just any bank, and again, depending on the conditions today are such that I would recommend you listen to the Chris Whalen forum post that Matt shared. He's basically saying that industry has been impaired in ways that we don't understand. And in light of that, if you're going to invest in a bank, does it make sense to instead pursue a JP Morgan? I don't know. But I know it's a worthy question, and it's one that Andy Dink would certainly roll around.
Well, and was the question there as well, Mark, when the home builders, went from PE values that were certainly very modest in the 8, 9, 10, 11, 12 range, and just plummeted to PE values of 2 or 3, and they did it over a very short amount of time,
Mm-hmm.
And they did it in a knee-jerk way where it was easy to laugh and to say, you don't know what interest rates really are, but I think 4, 5, 6, 7% interest rates were enough to basically destroy anybody that held onto those stocks during that period of time. And if you still hold on to them, well, you can hope that they're going to come back. You can treat them as deep value, and you can say to yourself, they just didn't collapse the way that they were expected to collapse,
Mm-hmm.
as far as sales are concerned, and yet the price certainly collapsed. And I don't want to be arguing something that happened no matter how good things looked. They weren't looking good enough to preserve the most important thing, which was price. So it's not that I like that topic, but I do think that this topic needs a place in our discussion, because I think it's one place where investors, us included, can be a little bit blind sometimes, and we move to generate all kinds of reasons why the decisions we made are correct, rather than having enough courage sometimes to say, enough is enough. You've given me enough pinpricks, and I'm bleeding enough real dollars that I'm going to step back and let
Mm-hmm.
the rest of you fight this out.
Yeah. Well, there's a couple.
Just a flesh wound. Just
Yeah.
a flesh wound.
Just a flesh wound, right?
Yeah. Again, as Matt pointed out very, very tactfully in that whole discussion on real estate and home builders, it is a local phenomenon, and that'd be one way to look at it. And the other thing I'm reminded of is I put together a tremendously wonderful overthinking of McDonald's 20 years ago, where I pointed out that the diameter of their burgers and thickness was changing, and that their profit margins were already exorbitant. Well, they're 50% higher now. So yeah, it's worth it's a worthy discussion, and I've got extensive notes here. So we'll try to go.
Maybe we need the word humility in here somewhere too, Mark.
Well, humility
It is there. It's down there. You keep missing it. It's in that third one bottom on the right.
How do you know all these words, Kevin? I don't know.
That's because I'm not a STEM person. I'm a liberal arts person.
Liberal arts person. Okay.
His eyes roll to the right and down, I guess. Okay.
I'm a STEM person that graduated from a liberal arts school, so that's certainly a different take on things.
All right.
Yeah, my roommates in college were all journalists, and they did it because they hated math. And we're bad at it too.
How about that? I have a kind of an emphasis on journalism, but I'm a math person. Okay. All right. I just wanted to spend a moment on this theme, and I'm tempted to put together another successful investing conference, at least conceptually, Ken. We like our pictures, and I just like the way that flows. And maybe I'm too much of a Kelly Clarkson fan, and probably one of my favorite songs from Hamilton. Where Kelly sings those very words. But yeah, it's an area of such tremendous potential that we've talked about a number of times. I mean, from the first time I invested, and Wendy and I bought shares of Waste Management, and late in the afternoon, and after I hung up the phone, because you still had to call Schwab on the phone to place a trade at the time, Waste Management went down in price. I lost consciousness. Wendy came home from work, and I had set out steaks to celebrate. She came home from work, put the steaks back in the freezer, and got out hot dogs. So I understand fear. I understand fear as a beginner, and there's obviously more to that story. But I think back to our adventures over the years, and this is kind of the theme I kept coming back to. I started a stock study analysis, a stock selection guide class back in Chicago in the western suburbs, where we taught through the adult education program. And I can so vividly remember a young lady that sat back at the back of the room. She faithfully attended our classes and learned the methodology as we taught it through the Chicago chapter of the National Association of Investors. And I ran into her, I want to say 20 years later. And she walked up to me and she said, you probably don't remember my name, do you? And I said, I don't remember your name, but I remember you. I mean, I can still see her sitting at the back of this class. And she went on to tell me that what you didn't know at the time, Mr. Robertson, so that made me feel older, what you didn't know at the time is I had just inherited a substantial sum of money. And she was probably her late 20s, maybe early 30s. And she says, I was terrified, and I didn't know what to do, and I didn't want to be taken advantage of. I just wanted to understand things better. And the classes that were put on by the local volunteers helped me. And she said, I just want you to know that I've had a very positive experience over these last 20 to 25 years since we were last together. So that, I mean, I know that you've got handfuls of these stories too, Ken. And, some of the stuff that we've covered during some of our recent sessions really underscore this so powerfully. And starting with right here, this notion of imagination. You wrote the article on the left, and we were just talking about fossil being stubborn. There's part of the fossil discussion back from 10 years ago. And there's Cy at the bottom basically calling us stubborn and too quick to sell and all that kind of stuff. And, of course, we have talked about the Mark Robertson not pictured moment on the right. But, again, this emphasis on we as a community work pretty hard to make something which is relatively unimaginable to the person on the street imaginable. Your thoughts?
Well, my thoughts are that this presentation can be made tomorrow night to a group of people that will really listen to you. And if that group decides that it's time for another one of these, we don't waste any time debating whether or not it's going to take us months or years to get something on the road. We sit down and just do it. we could very easily, Mark, be looking at another conference like we put on prior, and we can be looking at it in late September, early October with no real problem attached to it. So I'm suggesting that you better darn well be at the board meeting tomorrow night, and you better be helping the chair pitch some of these ideas so that we can take a couple steps forward from where we're at right now.
All right, I'll keep that in mind. I do have to do some running around, but again, you want to talk about discipline and how many times that discipline, and maybe with a dash of stubborn, has actually made a significant difference in many of the people around here, some of the people that are on the call today. And we believe in up, straight, and parallel. I think it's a very compelling discipline. Now, I also believe in non-core investing, not so much speculation, but non-core investing when opportunities present themselves. But the core, 70 to 80% of your portfolio, wants to look like this, I think. So we'll leave it at that for now. And then, of course, this slide, which, again, I just share in case somebody out there is looking for evidence to share with friends and family. The top 5 companies, these are the top 5 companies in the Manifest 40. They're the most widely followed by Manifest Investing subscribers, so they're not there as an accident. And you can see that we started the Manifest 40 back, and there's only one charter member here. I was kind of stunned by that. One charter member is Microsoft back in September 2005. So these other companies were added to the more widely followed companies along the way, including Apple in 2009. And I have a hard time with this one. Visa, not till 2016. Notice the returns over the time frame shown here, since this period in time, and the outperformance. And again, we take a look at them over a longer period of time, and we see downright staggering numbers that really do open up vistas of opportunity and make the case, as Matt Spielman made the case last week, and he has several times. Index funds are perfect investments for some people, but there is an opportunity to do better than that if you want to commit some time and effort and attention. And we can throw in discipline and maybe a dash of stubborn into that also. So, again, this slide.
Mark, on that particular point about being disciplined and stuff like that, I've been telling you, I'm reading The Intelligent Investor because we have a book club in our chapter that will be next Tuesday night. There's a shameless plug. But one of the things that Benjamin Graham talks about in that one is that yeah, you can just as easily do what, if you want to just sort of match the market, a minimal effort will do it. And this was, of course, in the days before we had ETFs and mutual funds.
Right.
But it takes a little bit more additional work to be able to get this kind of stuff.
Yep. It's what is possible, and it's what, again, these numbers here are virtually unimaginable to most people on the street. Many experts will tell you that they're not even possible, but they happen. All right, just a couple things to close down quickly. I put this list together using ChatGPT. I just asked the question, imaginable investment opportunities. That is an editorial calendar, guys. An editorial calendar that we should go through those and actually do some thinking about all of these. Why are you laughing, Ken? You like it?
I'd love to have a discussion about AI and ChatGPT and all the stuff that goes with it. And I'd love to keep making the point that human beings are creatures that want to progress, and they want to increase what they know constantly. And we're not going to do that if we walk down the road where AI and ChatGPT and all the rest of the stuff is the basis for our future thought.
Absolutely.
Enough said today, but of course, this stuff will be interesting, but is it really something? I'll leave it. I'll leave it at the fact that it's interesting. Okay.
Yeah, and I think this dovetails with some of the stuff we've talked about in the past with electric vehicles and all the components and all that kind of stuff. And again, the quote, imagining the unimaginable is the highest use. And again, I think that's kind of cool. All right.
I would put that up as a contender for the tagline, Mark.
Yeah.
And maybe just take the word "to" off and just the word "imagine the unimaginable." Good
stuff. So here's some stuff that we got coming in the future. We will be taking a closer look at these two situations, especially as the analysts bring the impact, the perceived impact to these companies. I drove right by Lilly here in the last couple of days. This was part of a Barron's article, a fairly recent Barron's article that I would urge you to take a closer look at if you want to understand this topic that we'll delve into in greater detail. And we would like to hear, what are your favorite things out there in the world of investing when it comes to webcasts or podcasts? And I've gotten a few responses. Again, just playing with ChatGPT just for the giggles. I asked ChatGPT, what are your top 10 podcasts? There's the list. Their votes were brought right into here. So we have a few responses, but would love to hear from you. By the way, Laura Scott sent the picture on the right saying that probably came off of her phone, the podcast that she listens to. So let us know. Send me a note or post it on the forum and tell us where you like to find investing ideas to explore.
It'd be interesting, Mark, if you identified yourself as the questioner before you asked the question, whether or not anything that you write would appear on the list then. What do you think?
Do you think that we should be on this list?
No, I wonder if ChatGPT panders.
Could be. That's one of the things I'm exploring.
You mean product placement type of stuff?
Well, I mean, if they know that Mark's the one doing the research, would they care enough about that to at least consider the fact that he has a podcast, he has a newsletter, that kind of thing? I'm not sure.
It would be interesting to see if there is any bias at all. I mean, I would compare it to Spotify. And Spotify obviously keeps track of the things that I listen to. I have a very eclectic taste in music, and it's fascinating how effective that algorithm is at Spotify at giving me a playlist. So
Mark, for music, you like both kinds of music, country and Western?
Yes. Very much so.
Oh, okay, we're not going there. Let's keep
Faith and Hill. Good stuff. All right, and then again, just a reminder that embedded in that editorial calendar, we do want to take a look in the future at go back and do a little bit of retrospective on life after Google and some interesting thoughts on the future of GE, infrastructure, and other stuff. So with that, here's your reminder that we do archive these broadcasts on YouTube under Manifest Investing, along with the roundtables and prior bull sessions. You can see them there. And just wanted to share that, Ken, you said earlier, so nice segue, sir, that the Portillo's restaurants in Florida are doing pretty good. Did some recent field research.
All right.
And Phil Crocker bought, I think. So thank you, Phil. And thank you to all of the individuals shown on the slide. They do good work. And they are part of that community that takes unimaginable things and makes them imaginable. All right. Anything else, Ken? We're running a little bit long today, but not too bad.
I'm ready to say goodbye to everybody. I have to go to a club meeting in a couple hours here, so I want to prepare for that. And anybody who wants to see what B.I. Baker is doing, we'll be meeting at the McFarland Library in Grand Blanc at 6 o'clock. You're welcome to join us.
Cool stuff.
Are you online, Ken, or just in person?
We are online as well, and if you want the meeting number, you'll have to send me an email in the next hour or so I can send you our response with all the information on it.
All right. Well, thanks, guys, and we'll keep rolling. Keep on rolling. Take care, everybody.
Good afternoon.